Ladies and gentlemen, welcome back to the program and thank you for keeping tuned here at Smart 24. My name is SSEBAALE and I'm your presenter of financial markets. And today, in a special way, we have a very special guest, Mr. Galamuzi Johnson. He's the manager, business development, finance trust bank, which is a bank that has been actually quite friendly to Ugandans when it comes to saving. So I'm going to hold a conversation with him, and I'm very glad because this opportunity we have to interact with bankers and stuff like this helps us to know on this show how we invest our savings. We are talking about saving, we are talking about investment, but the best people and with the expertise bankers have, they can always give us the best. Mr. Galamuzi, you're most welcome.
Thank you very much, Mr. SSEBAALE. More than honored and glad to be here at Smart 24 TV to share with our viewers on the nitty-gritties about savings, investments, and of course, how it ties into the capital markets.
Yes. Sure. Let's start right away with the conversation on what investment banking is. There's something always people talk about, investment banking.
Yes.
What is investment banking?
Well, to break it down a bit, of course, I can give you the real time that we get in textbooks and so on, but investment banking is basically about investing your money profitably within the banking sector and outside there. And the bank facilitates that. Investment banking, on the other hand, can be about investing on the capital markets and, definitely deploying your money. But in a layman's terms, it is basically deploying the money that you have put in the bank to make you more money. So you get to invest in that way. Mm-hmm. Yes.
So let's talk about now people who have savings accounts. They keep their money in there, and this money they get it out at the end of a certain period of time.
True.
Of course, that money sometimes reduces because there's a certain bank charge. Now, how different is investment banking in a way that you say you use your savings to actually invest? How different is it from a savings account?
Well, I'll start by bringing in the differentiation between the savings and investment. Now, for savings, you put money aside for a particular purpose, and then later on maybe you withdraw it, you go do your house or educate your children and so on. Investment is about deploying the money to make you more money. That means you have some money that you've been saving, but you get to deploy it in different ways on the capital markets. You can go into real estate and so on. It is investment generally. So in investment banking is that you use the money that you have and the bank helps you to invest it. For example, as an individual, you may not be able to take part in acquisition of bonds to treasury bills that are floated by the Bank of Uganda. We have unit trusts in different insurance companies and so on. So what the bank does, it helps you invest that money. We usually have the primary dealers and then the secondary dealers. The primary dealers is the first initial offerings. If you go to capital markets authorities and somebody is listed in there under the Uganda Securities Exchange and they've brought up an IPO, which is an initial public offer for people to buy shares where you'll get dividends later on, the bank can help you invest in that forum. Now, also in buying bonds. Bonds are long-term instruments that are issued by majorly the central bank to try and control inflation by pulling money out of the community or the people, and then definitely the demand and supply comes into play. When there's a lot of money that is chasing very few goods, definitely the prices will go up and you'll see a bit of inflation because it is a lot of money chasing a few goods. So the prices tend to go up. So in order for the government or Bank of Uganda to control that, they issue bonds. Those are usually long-term, or bills, treasury bills. Those are usually short-term, to pull money out. They're usually watertight. Even if the government were to change today and we get another government, the central bank still remains, and you'll get returns from them. They are usually not so profitable because they're usually not very risky in any way. So you get to, the banks will deploy the money for you. We also have other dealers along the way, like Crested Capital, you have have Bank of Baroda, even some of the major big boys in terms of banking have gotten licenses from the capital markets authorities to basically deal in that. So it's about investment, how you make the money make money for you. Saving, of course, you keep it on the side. We have innovative accounts at Finance Trust Bank where we will give you a bit of interest along the way. When you save with us, it's not like you lose money after you have saved. Okay. You make some money, but it is not a lot of money per se as compared to when you invest on the capital market or invest in something else that will give you a return.
Oh, thank you. Now, you talked about treasury bonds and treasury bills.
Yes.
Now, there's been a question of inflation, and the prices are skyrocketing in the country. Many people can no longer afford to buy certain commodities, even food per se. How does this treasury bonds and bills issuing control inflation? How can you take us through that? How does it control inflation?
One, for starters, it's all about demand and supply. You know, like I said initially, that when you have a lot of money chasing fewer goods, there will be a bit of inflation, because it means people have a lot of purchasing power, and the seller will name their price. I mean, if all of us are trying to purchase a car or trying to purchase goods, and we are 10 in number and we're all liquid, it means that the price will definitely, because the element of competition will come into play. Now, the government issues bonds, treasury bonds. These are liquidity management tools. I'm trying to simplify it a bit. Liquidity management tools to pull money out of circulation. Now, sometimes when you have depreciation in the dollar or appreciation in the dollar or in the shillings, it's because you have either a lot of the shillings chasing the dollars. So if you were previously buying a dollar at 3,500, if you have a lot of shillings, it means the shilling or the dollar will go to 3,800 because you have a lot of money that is available to you in circulation. So what Bank of Uganda does, issues instruments for people who are liquid, and this is where the banks come in to try and invest on your behalf. Of course, we have other brokers who do it on the side apart from banks. So they issue 90 days, 120. Those are usually.
Do you have to have the discretion of the customer before you buy the bond?
Oh yes, because it's their money.
Okay,
it is their money. You just can't wake up and start deploying their money. And that's where also we have the treasury departments in banks that usually look out, they get updates, and even part of the money that is, I would say, banked or saved with the banks, the way they generate the interest that they pay back to you at the end of the month is usually a result of what has been deployed on the capital markets in terms of purchasing bonds, in terms of purchasing bills and so on. So the difference in there goes to the client as results. Back to the issue of inflation. So when there's a lot of money chasing fewer goods, it means then the goods will become expensive, and that's what you call inflation. Today morning you wanted to buy a cylinder of gas and maybe it has gotten to 70,000 shillings because we have a lot of money chasing fewer goods. And I'll also break it down. Even if they're not fewer goods, it can easily come up as inflation. So what the bank does, or the Bank of Uganda, the central bank, it pulls out liquidity from the population. Now when it pulls down the liquidity from the population, it issues these bonds, people buy, and there is money out of circulation. Now that means at a certain point in time, when there is not enough money in circulation, either they can liquidate the bonds. So every time you go and liquidate, that is, liquidation is trying to get your money out of what you invested. It means there will be more money that is released into circulation. So in there, it causes a bit of balance in there. Now again, even what complicates why inflation may be a bit big is usually demand and supply. Now, when we have a challenge with oil and gas, the inputs that are used to manufacture because of one or the other reason, and it's not only limited to Uganda, it is worldwide. We've seen the oil prices go up and so on for one or the other reason. Most of the people keep talking about the war in Russia and Ukraine and so on, but the inflation has been around for quite some time, and some goods have been increased. So this time it has been a bit drastic. But in there, because the lesser goods and people are trying to run after them, it will create a bit of inflation.
Oh, thank you very much on that. But you see, there's another thing concerning the role of banks in this. The central bank rate has been lowered in the past couple of months because there was a drive for economic recovery. People wanted to access loans at a lower interest rate so that they can put back in their businesses and recover from this COVID pandemic. But now we have a situation where now there's inflation. And we want to actually reduce the money in circulation. What moves can the banks make, or what will the interest rate be? How should it be changed so as to fit this situation where there are two forces pulling? We want to recover the economy, but we also don't want so much money in circulation.
Well, for starters, what determines the interest rate of any lender is basically the risk that is involved in the lending. We have an element of the source of funds, because sometimes, just like I've said, you're going to invest this money, the banks borrow the money from the market in terms of taking fixed deposits from customers. Now, when they get the fixed deposits, it means that is an interest expense, and then they come and lend that same money. Now, if they're paying somebody 12 to 13% as a fixed deposit interest. Now that means there has to be a markup on top of that as they're lending it out. That is tagged to a source of income. Now, even if they've not borrowed locally, some of them source their income or source the funds that they're going to use to lend out from, equity, from shareholders, from investors who expect a return. Now, once that money comes in, they'll have to deploy it. So in so doing, it affects the interest rates. Now, when you talk of the interest rate that is set by Bank of Uganda, it also has a couple of elements in there. Now, that rate that is usually mentioned is what the commercial bank should borrow from the central bank for them to deploy the same amount. It is not as plain as it looks, that you go to, and get it at 9 or 8.5 or 10 or 12%, which we call the CBR or central bank rate, and then come and lend it otherwise. There are dynamics in there which include those tools that control the level of liquidity on the market. Because if they're just giving it out at that rate, then most probably you will find that even the market itself has a lot of money chasing fewer goods, which will also instead create a lot of inflation. So it's a balance of two, but it's all a factor of risk, the source of funds, and then of course the government policy that is in place, and then also what I would call the goals and objectives of that financial institution. Most of them, or most of us, are out to make money. At the end of the day, it's a going concern, it's a business, and you have to make a bit of money at the end of the day.
Thank you for that enlightenment. Now, talking about making money, we want on this program to encourage people out there to make investments with their savings. And one of the ways that you're saying banks can help do that is through investing in bonds and bills. Can you take us through the scrutiny of how someone and how much is required? Like, is there a minimum amount of savings that someone is required to have in order to put maybe their savings in a bill or in a bond? And does Finance Trust Bank, in that case, as a unique bank, does it have special offers for that case?
Yes, one for starters. It's usually broken down into shares or units, the bonds that we talk about, and most of them cost between 50 to 250,000
50,000. 50,000.
50,000 shillings.
Wow. So you can easily get
as 50,000 shillings.
That's a bond or bill?
It's either.
Oh.
Now it depends on the units that you're going to take up, or in terms of, are you doing 10, are you doing 20? We have some brokers who will tell you that we can only do 100 based on the amount that you're going to deploy and so on, and the paperwork and what is going to be involved, and the return at the end of the day. Because when you also invest so little, because it's a component of the interest that will be paid over what you have invested, it may be a bit of a challenge for you to realize a lot of value out of it. So there's usually a bare minimum. I would advise you, of course, if you came in with $1 million shillings or so and wanted to invest in bonds, nobody would say no, because that is your line of investment.
Yes.
But sometimes it's advisable for you to invest a slightly substantial amount at the end of the day. So when you approach a bank like Finance Trust Bank and you want to invest in that avenue, we also work with different stakeholders who are specialists in that area. We have forms that you fill, just like you walk in and you say you want to do a fixed deposit, the money is already on your account, or you're going to move it to your account, and then we'll fill a couple of forms, and then we'll definitely take them through the process. It's a process, just like when you apply for a loan, you go through appraisals, then after appraisals you go through the vetting committee, and then thereafter you get an approval, then you do documentation, and then they do disbursement, then you get the money, then we do a follow-up. It's the same thing. Now I wouldn't want to break our viewers by what we go through.
Yes.
For me, I want to give you comfort that when you come in and it's the available option, we will do it for you.
Sure.
We will make sure that we take you from process A to process Z.
Yeah.
Because then we'll be doing our job as bankers. But truth be told is that we do it, and we do it on behalf of our customers, and there's usually a commission that we take, which is 2% of what you have done as a brokerage fee for us to be able to help you invest in that area.
2%, meaning if I have 100,000, you only take 2,000.
Yes, 2,000 shillings at the end of the day.
Okay.
Yes, it's usually a standard to just cover up for those brokerages and other fees. But we do it as a bank, and we have a wealth management department that will give you all the available options. Sometimes the lower the risk, the lower the return. The higher the risk sometimes.
Is the risk determined by how much you invest? Is that what you're saying?
No. It's not determined by how much
because
you invest.
Because you also said that bonds are some of the safest instruments we have on the market.
Exactly.
Because government would definitely think can't default, right?
Wonderful.
Yes.
And therefore, since they're not very risky, the returns sometimes are not as massive as returns on, let me give an example, on unit trusts, where you invest with the different insurance companies or brokers and so on. And you can decide to liquidate 1 day, 2 days into it, and so on when you need your money. So they also don't invest in long-term ventures. Sometimes you have collection investment schemes that are run by the unit trusts, where they pull all your money together and they deploy it into bigger avenues, where somebody wants to do a partnership with, for example, somebody who's constructing the Karuma Dam and so on. They're looking for a bit of equity and so on. So the returns in there are also slightly higher, because then you're going to invest in a venture. Sometimes if you're buying shares, like we have on the stock exchange, we know they're selling securities exchange, they're selling shares for Uganda Clays, recently MTN and so on. At the end of the day, you pay dividends. And now dividends are depending on how the company has performed. I'll give you an example. Today, Bank of Uganda stopped any bank from paying out dividends as they monitor the situation because of the COVID pandemic. So if you invested in one of the banks and they've reported, we have banks that have reported very good profits, and the dividends will make the shareholders, smile all the way, but it is still at hold. Now, the risk there when you buy shares and so on the securities exchange is that when people are not able to pay the dividends, you don't earn from what you invested.
Okay.
I personally, I was one of the people who bought shares in SSEBAALE. I bought a share at 271 at that time because we're excited. Fast forward, the share has fallen to unbelievable prices. I am not complaining, I'm keeping it as value maybe for my children later on when it starts making money and so on. So the risk is there now. There the return is slightly higher because the risk is higher. For a bond, you're sure the government will be around. Everything will move on so well. So you leave it at that and see how things go.
Now, let me ask, what is the rate at which you can get a bond? Is there, you said it's a small return, but how small is it? Let's look at the figure.
Well, the bonds, depending on, because what usually happens is based on the rate that is given by, for example, Bank of Uganda, it keeps on changing. Every day there is a 90, it's actually on a weekly basis. We have a forum where they share with us. It can go down as low as 6 and even stretch as far as 10 or 12%. I've seen it happen to that. So you look at it depending on how fast they want to pull out money, and then you buy. The good thing, we have advisory bonds, we have brokers who keep us updated, and Bank of Uganda definitely also shares through the secondary dealers who have been registered, because not everybody trades in those bonds and so on. So you go in there and they'll tell you the running rate, compare it, and see whether it makes a lot of sense. But it fluctuates from time to time depending on the demand and supply and how much they want to release into the economy.
That's why I want to know. Now, for example, I have 100,000 and they have told me these bonds actually, when I invest, I have to wait for at least a year, right?
Those would be bills, treasury bills.
Bills only within a year, short term. So bonds are more than a year.
Yes.
More than a year.
They're more than a year.
Now, will I get back only 100,000, maybe plus 200 at the end of 5 years?
You get it with the interest that was agreed on.
With that, whether it fluctuated, we don't care.
Yes, we just, it's like a fixed deposit. If I fix today with a bank, I'll take it to the level of the fixed deposits that people really know. If I fix today and the rates are at 12% for a year, irrespective of whether that rate goes to 6% during the year, it's an agreement that you enter in with the bank to pay you that amount after a year. Same applies to the treasury bills and treasury bonds. I mean, at that particular time, that's why it is important you look at the prevailing rates. That's why it's important that you look at these brokers who will advise you. We call them financial advisors, for you to invest at the right time. Sure.
Wow, okay, interesting. So people can still actually check out this and still invest in bonds and actually make money for the future. As you saw, the COVID-19 pandemic hit and people panicked. There was no savings. People were actually given food around Kampala because people were hand to mouth, right?
Hand to mouth.
And this is affecting our economy so much. Now, there's something you talked about, the unit trust funds. Let's talk a little bit more about that.
Yes, the unit trust funds are usually out of now they're popularly done by the insurance companies majorly and other listed brokers along the way. The unit trust is basically you invest money. It's like a fixed deposit in a bank. You wait for a certain period of time and you are paid back with interest. It's usually interest ranges, they calculate on a daily basis. One that I practically tried as a sample because, of course, the direct competition for the banks and so on, so I had to go in and understand it fully. Pays on average at 10.3 to 10.5 on a daily basis. So every day when you have a certain balance, it keeps on paying you in that way. And the way they make money out of it is they use the one I said, that collective investment scheme, the CIS, where they pull all this money together. They get a lump sum amount and invest it massively. So that's how they're able to pay on.
So literally they're helping us like get our small monies,
yes,
put them together to make big money.
Yes.
When they invest this money, big money making big profit and big interest, right?
Yes.
At the end of the day, they bring it back as interest to you. Wow, that's interesting.
And the same applies to the customers of the banks. The same thing is being done. They'll take your money and invest it and give you a return on it. Now,
so that's something basically what the banks do.
Yes, it's what they basically do. But now, because of the cutthroat competition that is available on the market, the banks have become extremely innovative. I'll give you an example. We have a no-fee account where if you bank 100,000 shillings, they do not charge you anything. You come in, you deposit your money, and then you wait and actually just get interest at the end of the period.
Oh yes.
So if you bank 1 million shillings, you walk out with maybe 1.1 million shillings after a year or something like that. So it's become so competitive, even amongst the banks, in this fintech era, where people have no time to go to the bank and transact. They want to save, but also invest.
Yes.
We have innovative products like you get to fix your money even without coming to the bank. On our Trust Mobile app, you're able to send an instruction like you'd be pulling money out of the bank, but you just move it into a fixed deposit account and you start earning slightly more interest at the end of the day. So now we're really thinking out of the box as bankers on how to make things happen without inconveniencing customers. Because the moment you present convenience, then that becomes a tick for you. I know of a school that has introduced smart cards. At the canteen, nobody is allowing cash because people steal it in the dormitories and so on. All they're doing is swiping their cards. It looks like it is something in the future, but that's where we're going. Who knew that we'd be holding meetings on Zoom or on any other platform like Teams and so on 2 or 3 years ago? Somebody would say, that one is for those companies that have arrived and so on. These days we organize financial literacy workshops online and you have massive attendance and people are really, attentive and so on. Exactly. So for me, I see we're moving in the right direction, but key to note, saving alone will not take you far. You need to save and also invest. And some people think that investing, you have to go and open up a kiosk and then, you sit there, you get somebody to sit there. No. Read about it. Get in touch with us. Talk to your banker, especially Finance Trust Bank. And then we will tell you how your money can make money for you.
Sure.
Hassle-free.
Wow, interesting. Very interesting conversation right there. The saving culture of Ugandans actually has been dwindling over the years.
Yes.
We are people with the highest startups and still the highest number of close-ups.
Failures.
And the banking sector, as you have said, has come in to help and help people to invest and create and expand. What are the roles of banking in terms of investing in capital markets? Yes, we've talked about now the bonds and bills and so on. But how do you help the customer? Do you have incentives that will attract them to come and actually invest so that we increase our saving culture and investment culture?
Yes, we have incentives. I'll give one of the examples where we recently launched a Flexi Trust account. This was basically targeting people who are receiving payments from NSSF during this midterm access. As they plan to execute their projects, as they plan to do a lot of things once money comes into play, then people have a lot of plans for it. We came up with an account that pays them interest on a daily basis. As you plan on what to do with your money and so on, once you have an account with us, we treat it like a fixed deposit account, but this one is self-liquidating. If you had 10 million shillings today, what happens with a fixed deposit account is that if you fix for a period of 6 months and you come 5 months and 28 days and you say, I want my money, you lose the interest. Because we may have deployed it somewhere and we want to pay them back also and get that money and give it back to you. So you lose the interest. Now the Flexi account is very nice. It's sort of like the unit trust. You get paid based on the balance that you have on your account.
Wow.
the money is in there. Such if somebody has money out there, they get worried when they spend the night without banking it for them to earn overnight in terms of interest.
Yes.
Now, that is one of the ways we are trying to support. Now, when we talk to some of the customers, I have seen a customer who has received a payment and said, I don't know what to use the money for at this point in time. I'm comfortable. I've put up some apartment somewhere. They're giving me my daily income. I don't want to go into the hassle of starting a business or so on. Now, we do what we call wealth management. We advise them on how they can use that money to make them more money.
Yes.
Are they going to buy bills? Are they going to buy bonds? Are they going to just fix the money? Are they going to basically deploy it into ventures where we think they can make money? And we also lend for people as a sole purpose. Somebody wants to go and they know they have a steady flow of income, but they want money in lump sum for them to buy a particular number of bonds, to buy a building, to buy anything. We lend to them for a particular purpose, for them to go and create wealth. Because if I'm collecting, for example, 2 million shillings on a monthly basis from my different investments, it is easier for me to pay for a loan of, for example, 50 million shillings that I get in one go, and buy bonds that will continue, or bills, or fix it that will continue paying me back as I use this source of income to pay for the loan that I have taken. So one of the purposes that we finance is to acquire shares, is to acquire treasury bills, is to acquire treasury bonds, is to acquire a couple of things that make people's lives better. So in doing so, we're doing our core, what we call our core competence as a bank, lend to people and make some money off them so that you are happy at the end of the day.
Okay. Thank you very much, Mr. Galabos. We're going to go into a short break. When we return, talking about now Finance Trust Bank, what do they have in their docket specifically for you, their customers, and the people who want to enroll into their accounts and so on and start saving as you invest? Remember, this show is all about saving and investment. And we bring you experts like Mr. Galabos so that you don't remain in the back. Don't go anywhere.
Smart 24, driving business.